Hello, everybody. I'm Tim Jenkinson. I'm a professor of finance at Saïd Business School at Oxford University, and I'm hosting this webinar with Sergio Ermotti, who's the CEO of UBS in Switzerland. And Sergio is in Zurich, and unlike me, he's in his office. So welcome, Sergio, to this. And we were talking just before you started about the extent to which life is getting back to normal in Zurich, which might be sort of uplifting for some of us for whom life is not back to normal. So what's it looking like around you?
Well, thanks. And it's great to be attending this sessions. And well, I mean, there is a normality coming back, as I was telling you before. Maybe in our sectors, and everybody that has been able to work from home is probably still reluctant to come back. And so what I see is definitely more traffic, more people in shops, and probably in all those businesses that are not really enabled through technology to be fully operational. There is a need and a desire to come back to normality. Switzerland was somehow less affected by the virus because we were, able, I have to say, to take the lessons learned from Asia coming into Europe, Italy, particularly the northern part of Italy, and the south of Switzerland was very exposed, but was the lessons for the entire confederation to basically take actions and remediate and avoid a spreading of the virus. So now, we are coming back maybe also quicker there than other countries.
Yeah. Oh, well, that's reassuring. And maybe that's the way some of us will be in a month's time or something like that. Let's hope so anyway. Oh. Anyway, this webinar is taking a slightly different theme, which is financing the crisis. And I think the idea behind this was really to say, well, the last crisis we had was very much associated with the financial sector as the cause of it. This one clearly isn't. This is clearly something which is beyond anyone's control. But the questions that we're going to look at are, well, what role does the financial sector actually have to play in financing this crisis? Because obviously the crisis is having absolutely extreme effects upon many, many businesses around the world. And so what I wanted to do was to get the views of Sergio, who's right at the epicenter of this as a CEO of a bank, and to explore the role which the financial system, could be expected to play as we go through this crisis. And what I wanted to do to begin with, and I should say also for those of you obviously watching it on all the social media channels, please do submit any questions that you'd like to submit, and I'll try to take those as we go along. And I see so far we've got viewers from all around the world joining us. So please do submit questions as we go along. What I wanted to do was to start off really in the sort of more macro sphere as to thinking about the role of the different people who will potentially be financing this crisis. And in my mind, there are sort of three groups of those who are going to finance corporate businesses and indeed other organizations through the crisis. The first is obviously the government through direct schemes to fund jobs and all sorts of other things as well. The second one is really the private sector intermediating funds as sort of alongside government, which could be banks with loan schemes which are pushed through banks. And then the third one is really the banks and financial institutions themselves, the extent to which they are going to be financing it. And it could be banks, but it could also be real estate companies who are having to defer taking rents from people and the like. And Sergio, I was really wondering, what balance do you see is going to be what are the balance between those three different pots of money or pots of financing that you think how will that play out over this crisis?
No, well, I mean, that's a very good point. I mean, at the end of the day, in a nutshell, I think that in order to get out of this crisis, in order to manage the first phase of the crisis and long-term get out of this crisis, a collective effort is necessary. So I don't think that the three group of stakeholders that you mentioned in reference, all they need to play an important role. I think it's fair to say that the government took the lessons learned from the financial crisis. I would say that they were very quick and swift in announcing at least measures, which psychologically, in my point of view, was helping. Of course, then in some countries things got delayed a little bit, but the fact that people knew from the very beginning that they could count on a broader and massive investments by many governments was very helpful. So the banks, we are very happy that banks were not part of the problem or the problem this time, but are part of the solutions. I think that at least for the time being, that they are functioning really much as a transmission mechanism, as you mentioned before, because it's very it's not so easy. It's very difficult for governments to pass the money, and in many cases, you need to leverage existing infrastructure and making sure that the money goes to the right place to the extent possible in the most effective way. So, and I think that banks in general played a vital role in this process. The third one is, again, banks and other stakeholders. What can they do? Yes, I think that if I only look at our case, but I'm sure many of our competitors have had the same experience. We granted loans and extended credit for an amount that was 5 times larger than the total amount we passed to clients through the governmental programs. So you can see already that the financial system, the banks, were not only an effective transmission mechanism, but also were putting their own risk and money on the table. Now, when you look at banks in general, of course, going forward, not every banks will be able to continue to feed this system. Also, because one thing we have to remember, that banks have a responsibility to clients and to society in respect of being, a facilitator and granting credit, but they also have a responsibility to depositors, because people give us the money and expect the money back. So, and the money comes back only if we are able to deploy it in a way that is credible and sustainable. Talking about, you mentioned the real estate sector amongst others. Yeah, of course, in many cases it is possible for owners to grant concessions on the rent, but in some cases you have to also think about that themselves, they may be in trouble. So it's not easy, and there I think it's very important that where possible, private settlement or private agreements should be found, but where it's not possible, maybe the government has also to step in and try to find the most pragmatic way to help this issue.
Right. No, indeed. And in your view, I mean, how long? We've obviously had massive government intervention for a long while, and in some respects, this is really just investing on behalf of the taxpayers or the future taxpayers to support the current businesses. And there's a limit. There's obviously a limit to how long that can go on. But where do you think we are in that cycle? How much longer do you think government will be directly pumping money in to finance businesses? And do you think that we're getting towards the end of that cycle, or do you think that there'll be, in the same way there might be a second wave of the virus, there might be a second wave of financing coming in from government?
No, that's at the end of the day, I think it was necessary in the first phase for governments to take a very pragmatic and quick approach to de facto do an helicopter money distribution of money and basically keep people alive and also because there was a recognition that in many cases it was a governmental decision to shut down in order to protect health and the system, and so people could not really do anything other than applying those and implementing those orders, and and therefore they found themselves out of business, and no business can really survive if there are no revenues coming in. But the point, I do think that there is still room for some fiscal policy expansion, but it's not infinite. And I think that the second rounds should try to go into the more strategic part of how you want to help. We have to recognize that, unfortunately, not everybody will be able to survive this crisis, because in many cases you are talking about businesses and realities that were already in very stressed situation entering into the crisis, and this situation has only accelerated now. A very critical situation. So we will have to pay attention how to redistribute the money, because the point you mentioned is quite spot on in my point of view, that we need to say that at the end of the day, somebody has to pay. So, and we're going to have to pay. Of course, you can try to find ways, and you have to expect taxes to go up, but also, spending for other investments by the governments will be limited, and we cannot afford to distribute money out everywhere. So that's where, again, coming back into the private sector, I think the role of banks and financial intermediaries and academics and everybody in contributing, in advising our clients, stakeholders on how to think about the so-called new normal is very important, because people cannot really expect that we're going to go back into the same environment as before. I'm not saying anything new, but it's quite clear to me that anybody that thinks normal means what we saw till 3-4 months ago, it's under a big illusion. People.
No, indeed. And do you think, I mean, just to pursue that line of, what's the government going to do in the future? Clearly, the first stage of their response was understandably to lend money, to sort of defer tax payments, to pump money out through government loan programs, sometimes guaranteed, sometimes direct loans, and things like that. There's clearly a limit to how much some businesses can or should borrow, though, isn't there? It's the whole debt equity issue that many of these businesses are starting to, you stop operating for 4 to 6 months and put everything on your credit card, as it were, on your bank, on your loan. That can look pretty. You can come out of that looking pretty unsustainable. Do you think that there will be a role for government actually to take equity stakes in businesses in the coming months?
I think that in some cases they will, particularly, but it's much easier for larger groups and more systemic part of the equation. When you go down into the SME space, I mean, it's not easy, because at that point in time it takes a lot of due diligence and knowledge about the situation. So it's not going to be easy for governments to step in short term to recapitalize many of those smaller realities. And then there is, of course, probably it's more of a political kind of ideological standpoint of view. How far do we want to have governments going into the private sector, and de facto making the delineation between who is doing what in the economy and in our society a little bit too complex. So I do think that it's important for governments to facilitate this transition. I almost think that it's much better to think about, although we should not be too open and too generous to start with, but being open to forbearance and write-offs of potentially part of the debt, rather than becoming a co-owner and making it very, very complex and in my point of view, way too attractive for politicians.
That's an interesting idea, that you sort of put in, you write off the loans, and that's almost like equity in a sense that you're sort of putting into it. I think
but it's something that you need to do it carefully, because moral suasions, if people start to think that they can do it easily, that's not good. Right?
No, that's right. Now we actually have a question a bit related to this from Kurt in the UK, who says that in the 2008 we had a liquidity crisis. This time we have an impending solvency crisis, which I think is probably true for many businesses. And he asked the question: so, sort of, how are banks going to be able to lend in that situation? And sort of to tack onto that question, I've heard talk that the auditors are going to have a pretty hard time in upcoming audits, convincing themselves that there's a going concern in many for that they pass the going concern test in many of these cases. So, but yeah, the question I think directly for you as the CEO of a bank is that how are you having to change the way you lend to companies which in this where many of them are currently sort of have a high well, not necessarily insolvent, but there is a solvency crisis.
Absolutely, that's what I mentioned at the very beginning is a good point, and is exactly the real challenge here for us and for everybody to set the level of expectations right on what banks can do on their own in respect of funding the situations you mentioned. Because, as I said before, you don't want to put yourself into becoming also part of the problem as a system. So you need to really think about how you can advise and, of course, deploy capital and resources that are there to be used where you believe that there is a fair chance for this entity to go through the crisis and come out successfully. If it's not the case, you are creating a situation in which a bank or the banking system could become part of the problem, leading into its depositor clients fearing for their money, and you start to have a run on the bank. So, and then we're going to go back into square one, and where governments will need to come in and doing it, which, I don't think that the resolution of this issue can be governments put in more money for everything, because it's not sustainable. So it's quite important point that Kurt raised, and so we need to set the expectations correctly on what banks can do on their own.
And just to sort of round off the sort of macro things to begin with, macro questions to begin with, what's your view that at the end of all this, how will the business models of both the financial sector and indeed the corporate sector have changed, do you think? And indeed, will you assess risk of businesses in any different way? This is clearly something that none of us have ever observed before, and we're used to in business schools teaching people about the correlation of risks to the stock market. Systemic risk is what matters, beta type risk. But then you start thinking, well, is it a big risk to not have a digital channel to your business? Is a sort of major risk which might impact upon that, which isn't what we normally capture in statistical models and the like. I'm just sort of curious as to how you think our view about risk and the sort of business models that you're prepared to lend to will actually have changed.
Well, first, I think that we already, talking for our own experience, we are already going through the first set of lessons learned out of the last 4 or 5 months. And, while we, and one thing is quite clear, that we have been investing a lot in technology front to back. And in order to be prepared for the future of digitalization, and actually what it turned out to be was a very convenient investments that we had to utilize for some things that we never planned for. So such an acceleration of the onboarding of clients that were probably due to use digital channels over the next 3 to 5 years, they embrace it in 3 to 5 weeks. And a massive usage that is going to have a profound repercussions on the way we manage our interaction with clients, the way they interact with us, the way we look at our real estate footprint, and the way we will need to continue to invest in technology, and the fact that we were able to have 95% of the people working from home if you, and still the bank was having one of its best quarter, and it's running successfully. It's quite amazing and surprising, because our business continuity management program was always designed to an interruption of in your ability to locate people in a certain building. So we would need to move people to another building. Now we discovered that was not nothing to do with physical, was a virus, was invisible. And therefore, people need to go home. So rolling out and getting people to say, now you can use all this technology you have to do your job from home, has profoundly changed the way we communicate and interact. So we're not going to travel so much as before. We're going to really arrange meetings in different ways, also with clients and internally. Very profound. In the rest of the corporates and the economy, well, of course, the deglobalization that was already going on before COVID is going to be accelerated, because many people are starting to see, well, not only I need digital channels in order to be up and running and to be able to continue to deliver my services or goods, but I may need to profoundly change the supply chain on how I get to my base products. And that will translate most likely into opportunity and cost and challenges in different part of the value chain geographically or by underlying business. Maybe some increases of cost of the goods. Who knows? But of course, people will reassess, for example, how much liquidity they want to have.
Yeah.
Right.
Yeah.
So if you think about all this, it's going to take years for the shock to be absorbed. So I can't imagine anybody in the next 2 or 3 years not thinking that I need to have a buffer of liquidity that I will not need, but I better be there, because you never know what's happening.
Yeah.
So.
No, indeed, that's right. And just in terms of the sort of practicalities of it, do you think a larger proportion of your workforce will only come into the office sort of when needed, or when they have important client meetings, and that there will be some people where the new normal is to be in the office 2 or 3 days a week rather than 4 or 5 days a week? Do you think there is going to be something as profound as that?
No, I mean, look, I don't think right now. The peak was 95% of working from home. Right now, we are already down to the 75%, and I do think that the new normal will be the other way around. Most likely, you're gonna have, on average, people working maybe 1 day a week
at home.
But this is profound, by the way. 20%.
Yeah.
It's extreme and profound.
Yeah.
So I do believe that some people are say, well, of course, we had to manage a few challenges. That imagine a family in an apartment that's with kids that were not going to school, and both parents home working, and the worst case scenario for us was both parents working into, one working for a competitor and one working for us. So it was not easy also, particularly for the one who had confidential information, to manage the situation. So it's not practical to think that everybody can stay home, but from time to time, some people will stay home, and it will be easy. But some others told us, I'm much more productive when I stay home. Or I know that if I take 1 day a week, I can do 20 phone calls with clients uninterrupted.
Yeah.
While if I come to the office, there is always something going on.
Yeah. No, it'd be very interesting, I think. Now, we've got lots of questions coming in. One from Jessica, one of our MBA students, who's going to ask you a question which is so difficult. I certainly don't know the answer to it, so I thought maybe I should give it to you, which is that she says the market seems completely separated from fundamentals today, especially in the US, where the S&P 500 is gaining ground even on the announcement of bad news. What's your take on the market? Because it is amazing that the S&P 500, this week, hit the levels that it was at in January this year, right? So we're back to that, and then I think the Nasdaq is 10% above where it was at the start of the year. So strangely, to many people, sort of including me, the financial markets are sort of saying this is sort of over, or not. Well, you're in expectation it's over because markets are always forward looking, and yet to most people who are still locked down and worrying about the extent of business bankruptcy and unemployment coming around, it's sort of hard to connect these to most people. But have you got any perspective on this?
Yeah, well, look, I think that I would share that there is a total disconnect, and I don't know if it's just complacency of, or maybe there is something more profound that the equity market is telling us, that at the end of the day, rates are here to stay low for long terms. So people are starting to say, well, what is the risk? The risk-free rate and the risk premium of many parts of the equity markets should be reassessed, and therefore valuation should be seen in a different way. So the so-called "this time is different" can drive people to buy into the illusion that things can go over like that forever. So I'm very skeptical, and the reason why I'm very skeptical is because actually you see the credit markets are not at the level of December.
Yeah.
Both investment grade, high yield, and many other asset classes are still midway, or they are coming in. It's clear that this, optimism has created a little bit of buying into the market. But if I look at credit markets, and last but not least, banks, stocks are probably a better indicator of what the market and the broader investment community thinks about the future. So there is a less rosy picture coming from there.
Yeah.
So I think that I would share that is I'm surprised, and is and most importantly is way too quick, the rebound.
Yeah. And it's, as I suppose, it could be partly that some of those US indices in particular are very long, heavy on technology, which is sort of obviously a gainer here. So
yeah, but that was a good explanation till 2.5 weeks ago. By now, everything is catching up.
Yeah, it's true.
A lot is catching up.
Yeah. Can we shift a little bit to sort of what you've been doing, UBS has been doing for its customers? I mean, how have you been helping your customers through the crisis? And is there anything that's been particularly you've had to sort of change your practices or lending practices or the way you do things? Just give us a snapshot of what you've been doing.
No, very quickly, because I touch on these points. In general, I would say that other than I think that the most important role that we had was not just to be the transmission mechanism for governments and also give our own open up our credit lines to the clients, but I would say advising clients, no matter if they were corporate clients or individuals, wealthy clients, was helping them to navigate those difficult moments in the way they thought about their assets, their businesses, was very important. So I'm coming back into the most important part for us was to be up and operational, and to be seen as proactive and advising, not just supplying with credit, because just giving money without the context was not really necessary. So I think that this crisis has reiterated to me that banking and big chunk of the banking value chain is still about relationships and advice and human. So technology will always come in and facilitate, in some cases cannibalize part of the value chain. But at the end of the day, particularly when you talk about for an entrepreneur, for a corporate, for a wealthy person, when you talk about their wealth, their family, how to plan for the future, and so on and so forth. Nothing is more important than facing people and expertise and being able to interact. And so technology, again, coming back to what I mentioned before, the one that we used in the last few weeks or months now will be something that people will embrace more. Just to make you an example, we organize conferences on investment teams or so on. Usually, we have a numbers of fixed, average number of participants. Doing the same conferences like we are doing right now has translated into 3 times more people, more clients attending. So when we go back to normal, maybe people are more busy and therefore they won't be able to do what they did before. But I'm sure we're going to have much more participation through digital channels.
Yeah. And in terms of one of the things that's happened since the last crisis is that, where banks had to really bolster their capital ratios and there was much more care taken about the role of investment banking and corporate banking and retail, and indeed I know UBS has a real focus on investment management as well, and wealth management, and do you think now that obviously banks are in a much better position to lend and to weather these storms, because after a lot of the loans, I guess, must be going bad in a way, or looking doubtful. But do you think that there was a lot of care put to bolster those capital ratios, but were any of the stress tests that were put on banks, did they ever envisage anything like this? Essentially, the large part of the economy shutting down for several months, so was that one thing that was built into those stress tests?
No, definitely. We never really stress test for shutting down, but at least stress tests are something that we use as one of the most important tools in managing our risk and our capital is a stress test, and we have different taxonomies that we go through and we assess, and but of course many of them were something where in our scenario in a what we would call a global economic crisis scenario, where de facto I would say 80-90% of what happened, right? So we couldn't really say, well, it's because people are not able to go to work, but we would say, well, rates goes to down 100 basis points, and equity markets could collapse 20%, and you stress your credit, and de facto you reconstruct something similar to what happened. So in our case, I have to say that for many banks, this is something that we could reconcile and correlate with what we saw.
Yeah. And do you think that in general, what you're hoping is that at the moment it's difficult for many businesses to make their interest payments or the like, and so there must be a lot of deferral going on, I would imagine, across the whole sector, just like there's deferral of rent payments and deferral of tax payments, things like that. But is it in your view going to be a shifting of a sort of deferral of credit, and sort of people will build up an obligation to pay in the future, but the amount of actual sort of bad loans that come through might be smaller than people anticipate?
Now, right now, what you see for many banks, phase one, you saw the headlines of banks coming out with large loan loss provisions. One thing that you have to remember there is that the big chunk so far was losses related to modeling, where the input is the macroeconomic scenario that you have in front of you in different shape or forms that drives a pro-cyclical or anticipated credit loss that you may face over the next number of years or months, right? Whatever. And some of it is due to true specific impairment that you have to do because you have idiosyncratic problems with a certain clients. So what you will see as time goes by is, depending on the developments of the outlook for the economies, maybe the first element of the credit provisions normalizing itself or improving potentially, we hope so, and more of the realization of part of the modeling coming to reality, i.e. some people are indeed in difficulties. Now, for our own experience, I have to say that, by design, by strategic design, and by the nature of who we are, being a bank that is based in Switzerland, where we do banking 360 degrees, so we are exposed to personal banking, to SMEs, large corporates. We had the luxury to come into the crisis with a very strong economy in absolute and relative terms, and therefore, there was enough buffers of available to absorb the shock. Just maybe going back to the government program, it's quite interesting because if I look at the credit that we granted to on behalf of the governments or through the governments, 70% of those clients had no credit with us. They were able to run their business without any access to credit. Quite interesting. Mm. So only 30% had a credit exposure to us. Now, 3 months de facto into the crisis, the utilization of this program is only, the utilization of the credit line that we granted, it's only 45%.
Right.
So we have a luxury to come in with a strong economy, but I'm sure in certain countries, what you just mentioned is going to be very challenging, particularly going back to my opening points, that particularly for those sectors that were already weak and facing structural issues, there's going to be an acceleration, and that will be challenging.
Yeah. And we've got a question from Nicholas, who is one of our SBS students at the Saïd Business School, asking, and I don't actually know the details of the way the government loan schemes have worked in Switzerland, but obviously we in the UK, we've got various schemes like the bounce back loan scheme and things like that, which are administered through banks, but they're essentially government backed. Do you think there's any doubt about the ability to get when the loans go bad, some of these loans, do you think there's any doubt about the government paying up to the banks, or have you got a similar situation in Switzerland where the government has asked you to pump the loans out but is guaranteeing them? Do you have any doubts about that guarantee?
Well, you have always to have a healthy skepticism, yes, of course. So what we try to do is to make sure we do our job correctly and we don't make mistakes in granting loans to situations that are in breach or not fulfilling the requirements, so that you don't become an easy target for those potential clawback claims. I'm positive that it won't be the case, but I would never put my hand on fire on that one. So it's to be expected. But again, we all know that at the end of the day, somebody will have to pay for it, and if it's not, most likely we're going to see the necessity to increase taxes and find ways to fund this issue. But we have to pay attention how we do it, because we don't want to fix one problem and create others.
Yeah. And one final question, really, which coming in from Mustafa, one of our executive MBA students, which is, clearly UBS has a particular sort of constellation of businesses, which is quite heavy on the wealth management side compared to some other banks. And do you think that the crisis is going to change in any way the relative profitability of the things that banks do? Not necessarily just yours, but there's clearly retail banking, investment banking, corporate, wealth management, things like that. Do you think it changes in any way the attractiveness of those? Because obviously banks are pursuing their own strategies, and some of them very, very different strategies. But are there any obvious ways in which the crisis would make one rethink the relative attractiveness of those different types of line of business within a bank?
Look, I don't think I'm going to say anything that I haven't said before. I think that yes, if anybody was still not convinced about the fact that technology and digitalization has been and will dramatically change any part of our economies, but also our financial services and banks. Now you got the final proof. Now, of course, we all know that in many cases, people usually, when you have these major changes and trends, there are phases in which people are expecting way too many changes in terms of timeline, and they are overly emphasizing the time, the duration, and how long it's going to take to make changes. So they tend to think that there's going to be a revolution short term, and underemphasize the size and how big the impact will be for the business. I think COVID has accelerated to some extent something that would have taken 3 to 5 years to crystallize into few weeks, and so in that sense, you will see an acceleration, and some people will need to really profoundly change their business model, or they will be forced to merge or to sell themselves to other players because they won't be able to fund the technology investments that are necessary to survive. The second aspect which is the opposite, is what I mentioned before. Value of advice for banks has proved to be still an asset. Yeah. So you need to work on the two dynamics. So basically, expect some continuity in the value of advice, although your people, so people remains our people remains the most important assets we have. What you need to do is to make sure that they get the best tools available to be smart, fast. When they serve clients, you need to make sure that they have access to constant learning. They develop their skills as the situation evolves and change. But on the other end, technology changes everything.
Can we just a final sort of area of questions I had in my mind was other players, the way other financial institutions are going to help fund the crisis, if you like, and I can think of a few of those which I just want to touch on. But the first one I wanted to ask you about was, if you like, I don't know whether we now call it shadow banking, but private credit. There's clearly been a lot of a huge growth in the idea that a lot of the loans that are being given to corporates these days are not going through banks. They're actually going through funds which are raising money from large institutional investors and then doing direct lending into corporates. And that's clearly, in my day job, I spend a lot of time on the private equity and private credit side. And that's been, as far as I can see, the hottest ticket in town for the last 3 or 4 years amongst institutional investors. What's your sense of that? Because presumably these were sometimes lending on a leveraged basis into corporates, which feels like it ought to be, not the place to be at the moment. But have you got any thoughts about private credit and that side?
Well, you look like you already answer yourself. So I think that this crisis is going to be a good stress test for that business model, because of in a bull market and in a normal market environment is easier to disintermediate the more traditional channels. But when a crisis comes and when loan losses will come, you will need to see how much capital is available. And the second point, which even for large organizations, the first few weeks of the crisis, there was an element of liquidity tensions in the markets, and central banks had to step in. So imagine those smaller entities that have really limited access to capital markets and funding tools. It's not easy to do just brokerage. I mean, brokerage, fine. I suspect that, and I see it. We also do it already now in Switzerland. We do broker ourselves mortgages. We don't keep all the mortgages. We may facilitate different people. So for somebody to come in and disintermediate the traditional banking channels is not easy. But of course, also remember that many of those realities had regulatory sandboxes that were there to facilitate innovation, which is welcome. But first of all, over time they create an unlevel playing field, and most importantly, when they get to be big or bigger, the necessity for the prudential regulation to come in and regulate will make them very similar to us. Therefore, a lot of advantages will disappear.
Right. Interesting. So it might be that the crisis sort of almost makes these things a bit more regulated in some ways.
Well, I mean, you will see when you start to have defaults and people losing money, usually is when regulators comes in and take out the sandbox where the kids can play.
Yeah. And in terms of the other, I mean, another obvious area which could step up to the plate is equity markets. And I saw in the Financial Times this morning, actually, in the context of the UK, that £10 billion has been raised from new equity issues by existing companies on the stock market since the start of March, which is interesting, and it was quite a lot of small and medium-sized enterprises which were doing this and raising, a few tens or hundreds of millions of pounds to support themselves. Do you think that I don't think we've really seen that play out as much as I might have expected yet. But do you think that is going to be a big source of this? It goes back to one of my earlier questions about should government put equity in? The alternative is, of course, the private sector puts equity in.
And I think that you saw that developments in the UK, you also, in general, a little bit of that happening everywhere. I do think that in few months' time, I think that there is a good chance that, once the situation is stabilized, that the pools of liquidity will look for opportunities, and that when people have more transparency and guidance about the future, capital will be available to recapitalize situations, to get them back into more sustainable standing, or to allow some of them to capture the opportunity to grow their businesses both organically or non-organically.
And presumably, I mean, if it makes the world of negative interest rates last even longer, which I'm not sure it does, because after all, the fiscal deficits are going to be such that you might expect these things to go the other way. But if they are still going to, I mean, Switzerland, I think, has negative interest rates, right? So, it must make that there's still that imperative to sort of find any return. You look to risk assets, don't you? So I suppose that the relative attractiveness of equity, of putting equity into these businesses at this stage isn't necessarily, it's still there relative to putting your money in and paying the government or paying to lend to the government.
Well, look, as I mentioned before, there is a lot of liquidity in the system. I mean, if you just look at private equities, it's still a lot of, north of $1 trillion, 1.4 trillions of cash available, and of course, private equities are investing over a cycle of at least 5 to 7 years, so they may have been busy right now also in looking at how to assess their portfolio, put liquidity into the existing portfolio. But I'm sure that part of that plus part of fresh money out, through other channels will come in and be part of the solution. But again, at the end of the day, it all depends how the situation develops in respect of coming back to the so-called now new normal, and how quickly vaccine and remediation for COVID would be found. So which I think is going to play out in the next 6 months, 6 to 9 months.
Yeah. Now we got a question from David in Malta saying, asking you, this is again a tricky question. I'm not sure I could answer it, but to what extent do you have any sense as to what extent you think the government loan schemes are actually sort of propping up businesses that just aren't going to survive? That they're sort of, they're done with the best of intentions, but they're sort of hidden unemployment schemes, where. So a lot of these European schemes have been to support businesses to then furlough workers, and then, with a hope that they're going to survive. And in the US, we saw unemployment shooting up because the payments really went to the individual, and then in a sense the business can, that was the way it was mediated. But do you have a sense as to what proportion of the companies that have taken the initial help may not actually ever come back?
There's two of us that can answer that question. So I don't know. I think that if I look at probably the best leading indicator, if I think about, is really to look at in the next couple of quarters in the loan loss provisions of banks, how much is coming from that part that I mentioned before is driven by impairment or of loans that are not driven by modeling, right? That may start to give you a little bit of an indication. But as I said, it's absolutely clear that an important part of those intervention is money lost.
Yeah. And we've had a few, because we have people on this call or this video from all around the world, and we've got some coming in from Latin America, where clearly the virus is still, is a slightly different phase, slightly delayed relative to how we've seen it in Europe. But we've got a question from Victor in Mexico saying, have you got any views on the emerging markets side, in terms of Latin America? Do you see the economy or the interventions there being more effective or as effective, or are they a big worry? Do you have any? I don't know whether you have any businesses in Latin America or the like.
No, we have it, and in any case, we are interconnected through everything that goes on. Of course, emerging markets and in general countries where maybe also there is big disparities, a big chunk of people who are living with very limited financial strengths are the most exposed to a crisis like this one. So people who have less access, countries that have less access to medical care and a functioning medical system are hugely exposed to that. Also because if you think about in the Western, we have been very lucky that, some people or some countries more than others, but we have been lucky that we could afford to shut down. In some places, probably they can't. And even, it's not even an issue of the governments. People would say, well, I'll rather take a risk than not being able to feed my family. So, I mean, it's quite dramatic, that situation. So it's not easy to make an assessment, but, I think that, of course, we have to be very, very realistic that, unfortunately, for many, many countries, it's going to be a painful toll, painful experience, and very tragic price to be paid for this.
Yeah. Sergio, thank you so much for answering all these questions from both me and from other people around the world. It's been fascinating to hear, what your perspective is from the point of view of a major financial institution. Your calmness and optimism is rather reassuring, actually, and so that's rather good. Often one wonders where the people who are actually involved in dishing out the money and monitoring it. You wonder what it must be like. But it's, as I say, thank you very much for answering all the questions so clearly and covering all those wide range of topics. I wanted to say one final thing, which is that this is one of a sequence of webinars which are happening over the next over the coming weeks. And the next one on next week on the 18th of June will be on the topic of the complexity busters. And so that sounds like an interesting and completely different topic. It'll be led by Professor Harvey Mailer from the Business School here, and it'll have a wide range of people involved in it. Lieutenant Colonel Tyrone Urch, who's one of the very joint commander of the British Army, Lara Sampson from the Department of Work and Pensions, and Emily Ackroyd from the Government Digital Service. So if you're interested in that, please join that. And thanks for joining this webinar, and I hope you enjoyed it. And thanks again, Sergio.
Thank you.